Happy Tuesday out there, folks. This is Darius Dale here to present our macro minute for Tuesday, May 10th, 2022. Starting with markets, we have stocks up this morning after yesterday's bloodbath. Commodities mixed with agriculture leading. Crypto up, dollar down, global bond yields down. Not a ton of market moving headlines this morning, so I thought I'd shine some light on the profit cycle. So you have Peloton, which has been an absolute dog over the trailing 12 months. They came out and missed Wall Street estimates for both sales and earnings. I thought the miss on earnings was pretty noteworthy. The net loss was just shy of $1 billion at 757 million, compared to an analyst estimate of 132 million dollars of profit declines. And so that just gives you a reminder that operating leverage works both ways. And what we mean by operating leverage is the ratio between fixed costs and variable costs that tend to have outsized influence to both the upside and downside on earnings estimates. We'll be doing a deep dive on our profit cycle analysis in today's May 2022 macro scouting report. For those of you who have not had a chance to view that, I think these are the best decks you'll see across Wall Street, and that is a challenge to anybody out there who puts together decks. I'm a competitive guy, and I happen to think ours are the best. But one thing I flag as Wall Street analysts, they cut 2022 earnings estimates for the second straight week. This is the first time we've seen back-to-back weeks of earnings estimates decline since 2020. We believe, and we talked about this in the late off morning note last week, go check that out, that the modal outcome is starting, the sort of earnings recession is slowly shifting towards the modal outcome from an expectations perspective. I happen to think an earnings recession is actually more likely than an outright recession. Obviously, if we get an outright recession, we're going to get both. What shifting gears a bit out, it was a cycle all along. So, just days after Kathy Wood issued a warning against passive investment, her flagship ARK fund, which has been this sort of, the innovative, yada, 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 marketing this, marketing that. By the way, she's world class at it. And I'm certainly not no disparaging Kathy Wood. I actually like her. Her fund's return since its 2014 debut is now lower than the S&P 500. So take that for your innovation, huh? One thing we'll also touch on in today's macro scouting report slide deck, we're going to talk about this concept of, okay, when do you buy? As I mentioned several times in the past month, only the fools buy when there's blood in the streets. You don't want to be a fool. You want to buy when you hear the sound, the faint sound of Federal Reserve ambulance sirens. I thought Atlanta Fed Governor Raphael Bostic gave a little faint whisper on that yesterday, but obviously it wasn't enough, and it will not be enough until we get inflation under control or until financial conditions tighten enough. We'll walk through all the things we're looking at in great detail in that presentation today for 42 macro subscribers. And then we'll also kind of unpack on what we're looking for to increase our exposure to duration. The whole world is short duration and across every liquid asset, pretty much across every non-liquid asset as well. So clearly there's going to be a massive move higher in terms of repricing duration risk on the other side of this inflation spike. So we're looking at the timing, what we're looking at from a signaling perspective, et cetera, to give us a leg up on the competition in terms of rotating into duration. Because again, I don't know if you folks know this, a lot of folks watching this program don't understand the kind of returns you can generate when a bond yield from, let's say, 10-year Treasury goes from north of 3% to say 1.5%. You're talking about 20+% returns on a capital appreciation basis. Big movers, Ethereum up 5% to down 27% month over month. So again, big green bounce today. Euro 1 year, 1 month overnight index swap forward. That's down 9 basis points today to 1.23%. That's up 10 basis point month over month still. So you're taking a little bit of pressure off the ECB there from a market pricing perspective. Shifting gears to our probable range analysis and volatility adjusted momentum signals. Dollar still bullish. VAMs minus 1.8% downside versus 1.2% upside. We bought the geez, what a buy on the dollar down there back in June. New York gold neutral. VAMs minus 1.2% downside versus 4.8% upside in its probable range. 2-year Treasury yield still bullish. VAMs minus 21 basis points of downside versus 29 basis points of upside. So that is that's a somewhat a fair fight there. I mean, you can generate a crap ton of returns just taking bond yields back to where they were in early March. I mean, so let's be aware that obviously we're not trying to front run the process, but we certainly are eyeing that as a next likely pivot to take down some of our very elevated cash position, which has been fantastic to sit here and play the game from the front foot and kind of lick our chops on what to buy next. Bullish high yield OAS, that's still bullish. VAMs minus 65 basis points minus 65 basis points to the downside in its probable range versus 12 basis points of upside. S&P 500, that is still bearish, FAMS at minus 4.4% downside, 7.8% upside. VIX is still neutral, FAMS. Vol's underperforming conspicuously throughout this recent decline since early April, minus 40% down, downside versus 15% of upside. So NASDAQ 100 bearish, FAMS still. You got minus basically 6% of downside, 11% upside. Russell 2000 minus right around minus 4% downside with 10% upside there. Bitcoin bearish, FAMS still. I mean, what I tell you about these bearish VAM signals, what I tell you about these bearish VAM signals on crypto, what I tell you about it, this signal works. Bearish VAM still minus 22% of downside versus 23% of upside. Ethereum bearish VAM still minus 7% of downside versus 21% of upside. Shanghai Composite bearish VAMs minus 8.3% of downside versus only 2% of upside. Again, this is a chart that does not look like it's going to rescue the world from a reflation standpoint. A lot of folks are just flat out getting that call wrong. I've been hearing that for the last 6 weeks, and guess what? It's just wrong. Move on. WTI crude oil, neutral VAMs, minus 7% of downside versus 12% of upside in its probable range. Ag bouncing this morning, neutral VAMs off the lower boundary of its probable range right there. Boom. Minus 9% of 0.9% of downside versus 5.4% of upside. And then industrial metals, we flagged this last week. We flagged it in our Around the Horn presentation on this weekend, preparing investors for the sloppiness which we saw yesterday, and we're flagging it again today. This is demand destruction, ladies and gentlemen. I guarantee you, if it keeps this up in the coming days, the volatility adjusted minimum segment will be bearish, and this will be one of the first major commodity exposures from a inflation signaling standpoint, rather, to go bearish FAMs. And I think that will be a canary in the coal mine for those of you paying attention to the pending sea of Ds for the back half of the year that we have in our grid model forecasting system. So with that, catch you back here tomorrow. And as just one last reminder, if you want what to do, and you want to where we're going, and you want to how to figure out how to manage risk and risk, and you want to figure out when the ambulance hours are coming, all the stuff that you need to look for. You don't have to spend 10, 20 hours a day on FinTwit scouring tweets and doing this and that. We put it all together for you through the lens of someone who's very experienced and very good at his job. So we appreciate all our subscribers, and we appreciate all the new ones that we're likely to get today. So thank you guys. We'll catch you back here tomorrow. Cheers.